When it comes to trading and investing, it's not being biased to one side. It's not being emotional and attached to one side. You are not a trader. You're not an investor. You're actually just a risk manager.
Look that up. It's 7.57 billion people.
Miami, Texas, LA.
Peace, everybody, and welcome back to The Money Game. I'm your host, Dion Pouncil, and I want to thank you first and foremost for joining me on this episode. So in today's episode, we're going to be talking about risk management, right? So we can't really talk about trading and investing and even business without talking about the risk, because at the end of the day, before you take one trade, before you take one investment, or before you invest in any company or any business opportunity, you need to count the cost. You need to know if the juice is worth the squeeze, as I like to say. So starting off, you need to understand that no trader, no investor, and no business person wins on every trade or wins on every opportunity. Just the law of probabilities, it's not possible. Okay. So if anyone ever tells you that they don't lose or they never lost, go the other way, because it's a high probability, a very high probability that they're lying or it's a scam. So that's the first thing. The greatest investors of all time, Jim Simons for the quants, and they run their algorithms and run their trading shops specifically off of trading systems and trading algorithms that are completely ran by computers. And he has famously stated that their average win rate is 51%. Okay. So if this is the greatest mathematical financial trader of all time, technically right now, because of his returns, and they only win their trades about 51% of the time, then that lets you know what the average professionals or retail traders are doing. Warren Buffett has had large, major, high profile losses. Okay. It's a part of business, whether it is trading, whether it's investing, or whether it's starting a company from scratch. You're not going to win every time. So that's the first thing we have to really understand, is get our mindset right of knowing how to hear and listen to people who talk about trading and investing or business opportunities, but then knowing that you're not going to win every trade. The key for this mindset approach is going to help you deal with your emotions, right? So I always say, if you can control your energy and you can control your emotions, you can control your world, right? Because what you are going to be able to do is you're going to be able to look at things objectively. And this is going to allow you to not look at things with bias, right? I'm not a bull. I'm not a bear. I'm a winner. And winners win. We find a way to win, or we make a way to win. When it comes to trading and investing, it's not being biased to one side. It's not being emotional and attached to one side. Because as I teach my students, you are not a trader. You're not an investor. You're actually just a risk manager. So when you understand that mindset and you take that approach on everything, it puts you on a level playing field with the ability to look at the data objectively, whether it's your research, whether it's your fundamental analysis, whether it's your technical analysis, whether you have algorithms that are helping you generate buy and sell signals, whether if you're looking at real estate investments, whether you're looking at gold, stocks, bonds, options, forex, futures, crypto, art, whatever it is that you're considering, you're going to be able to look at that data objectively, see it for what it's telling you, and identify based off of your risk parameters, is that opportunity or is that reward worth what you will have to risk up front? Okay. So let's talk about a couple of practical things, right? Number one, some people would say, well, I don't trade and I don't invest. Well, you actually have trade in everything that you do. When you go to the gas station, you are literally trading your money or your money energy for that gas resource. You are agreeing and identifying that, hey, here is the price of gas at this current moment. And I want to purchase 1 gallon, 10 gallon, 20 gallons. And I believe that me risking putting my credit card in here or handing them cash, that the reward of me getting gas for my vehicle is worth it. And so you've decided to make that trade. When you go to the grocery store, you are trading your money energy for the food, right? When you go to work, you are trading your time for the desired goal of your business or for your employer. So everything you do is a trade off, all right? There's really no such thing as balance. Because when you put time, energy, effort, and resources into something, something else is going to suffer from it. Okay. It's literally just the laws of physics. Okay. So we want to understand these things and have a solid approach mentally towards them because it's going to help us deal with the trade or the investment. Okay. Or the business opportunity that you are considering. So, what I like to talk about is if you don't prepare to win, then you're preparing to fail. Okay. So, when we start preparing for the wins of these trades and investments, we already put ourselves in a higher or a better position to win because we have more information, we have more data, and we can make an educated, informed decision rather than just rolling the dice, gambling, putting it all on black, or pulling down the lever on a slot machine, right? So let's look at one of the greatest bettors of all time. Who do they bet on? They bet on their sales and they bet on math. The casino, a lot of people like to say the house always wins. The casino is not gambling. The humans who go there are gambling. The casino is particularly based off of probabilities. So they select games specifically where they can have the advantage. So the last time I checked, slot machines, the person who sits down starts at a negative 30% disadvantage. So that means that when you sit down, you don't have an even 1-to-1 or 0-to-0 chance of winning. You actually start at negative 30%. Okay. The craps table is you start at a 50-50 chance. If long as the dice are not loaded or the table is not tilted, you have a 50-50 chance. Okay. And in blackjack, you can actually get an edge. You can get up to about a 0.6 to like a 1% advantage over the house if you know how to count cards, right? So you have to have a mathematical system that you've trained your eyes and your mind to know, and you're able to do that in real time. And that's the only way that you can get an advantage on the house. And then you also need to be able to bet properly so that you can actually win. So when we're looking at one of the most successful betting systems of all time, which is the casinos, their entire approach is mathematical. So we want to take that same approach when we're talking about risk, right? So let's keep it simple and let's keep it practical, right? How can I look at a trade, look at an investment, or look at a business opportunity and have some simple numbers to say, hey, you know what? I believe this juice is worth the squeeze, or I believe this reward is worth the upfront risk. Well, the main thing that I like to teach the students is what I like to call the 5% rule. And you can apply this in anything in your life. The 5% rule simply is if you have $1, you don't risk more than 5 cents for any individual trade. So that's $5 for every $100. That's $50 for every $1,000. So if you're starting in your trading account or you're looking at an investment or you're looking to buy, something that you like, some shoes, a purse, some watches, a house, etc. What you want to do is you want to look at your available disposable income. Okay. So number one, you're going to say, how much disposable income do I have? Right. So disposable income is not your lifestyle money. It's not your rent, your bills, your car note, etc. It's not your emergency fund money, the money that you live off just in case your lifestyle money is affected through your job or natural disasters or something like that. Disposable income is literally you could take it out of the ATM, go in the backyard, and set it on fire. Okay. So you only want to trade, invest, or look at business opportunities with disposable income. That's number one. Once you identify your disposable income, number two, you don't want to risk more than 5% on that individual opportunity. So if you start your trading account with $1,000, you should not risk more than $50 on one individual trade. This will allow you 20 individual trades at maximum $50 per trade. This will allow your money to last longer than just betting it all on one trade or putting it all on one opportunity. And then this will give you 20 chances to actually win and or grow your profits. Okay. So that's the 5% rule. Another simple way to look at the 5% rule is if can I afford this at this current moment 20 times? Because 20 times 5 is 100. 20 times 50 is 1,000. 500 times 10 is 10,000. So if I have $10,000 available, I should not risk more than $500 in one individual opportunity, and so forth and so on. Okay. So if I look at my risk parameters and I look at this approach, now I'm only doing things that are within my disposable income amount. I have my 5% rule, and now I have two filters or two layers that I have as I look at this opportunity. And when you look at an opportunity, whether it's a trade, investment, or business opportunity, I want you to think about when you look up hotels or you look up Airbnbs or you look up flights or you look up rental cars. Every question that they ask you that you check off is a filter. And every filter question that you answer is going to eliminate the cars or the hotels or the Airbnbs that they're going to show you that are available. So each one of these risk parameter questions you're going to ask yourself, before you risk one penny. And this is going to allow you to filter out the BS that you don't want to risk your money on. So filter number one, disposable income only. Filter number two, the 5% rule. Okay. And then filter number three, you're going to ask yourself, what is my desired return on investment time frame? That means that when I put $1 into this opportunity, when do I want or expect my money back? Okay. So for an investment, you're thinking 1 year or longer. Okay. So investing is 365 days or longer. That's not just a random number. It's actually the number in the eyes of the government and the IRS where an investment becomes a long-term investment. Okay. And you can avoid up to 40% capital gains tax simply by holding something for 1 year and 1 day. All right. Talk to your tax and accounting professional to see how much taxes you can avoid with the 1 year or longer strategy. Okay. But when you're looking at an investment or you're considering an investment, you are saying, I'm putting $1 into this and I am not expecting $1 back shorter than 365 days. Okay. When you consider trading, trading is 365 days or shorter. So if I put $1 in today, I'm expecting the return on my investment in 1 year or shorter. All right. So trading is literally from nanoseconds to 1 year. And we'll get into that deeper in another episode because right now we're just talking about risk. But we need to understand that, yes, putting our money to work for us is good. Yes, we can do it in different ways. One would be investing, one would be trading. They are similar, but they are different. And the major difference between investing and trading is the desired return on investment time horizon. Okay. So trading 1 year or shorter, investing 1 year or longer. So now once I've identified when do I want my money back, that is now a filter because some opportunities maybe 1 year, 3 year, 5 year, 10 years, and you might not be in a position to where you can wait that long. So you would filter that out. Or if you're looking to trade, you want to know the time frame in which you have that opportunity. So for an example, scalping, those traders trade from, seconds to minutes. Whereas position traders, they may trade from months to years. Or swing traders may trade from weeks to months. So identifying your time frame that you're comfortable with, the time frame that your risk parameters will allow, and the time frame that your bag, your money will allow, will also help you filter out those different risk parameters and those different opportunities. Okay. Then the fourth thing I want you to look at is the asset class. What asset class are you considering? Because different asset classes have different risk, right? So assets might include stocks, bonds, options, Forex, futures, crypto, gold, diamonds, art, real estate, technology startups, becoming a limited partner or investor into a venture capital firm, into a hedge firm, into a private equity firm. Each one of these asset classes are going to come with their own levels of risk, and you need to know and understand how risky or how non-risky those asset classes that you're considering. Okay. Now, the fifth risk parameter that I want you to consider is after you've selected the asset class, then you want to actually select the actual instrument that you're considering trading or investing. So, for an example, if you say, hey, the asset class that I want to trade or invest in is stocks. Okay, well, now you got to identify which stock, right? So maybe Apple, maybe Amazon, maybe Tesla, maybe Google, whatever it is, you have to now identify that actual instrument, that actual stock, or if it's, the option, what contract, if it's a futures, what expiration date are you considering? If it's a crypto, what coin? So you start to filter out and get more narrow in your search, and this will allow you to, again, eliminate certain risk. Okay. So you've now identified the actual instrument that you are going to be trading, investing, or purchasing. Okay. And so now, after you've identified the asset class, now you want to identify your strategy and your approach. The sixth part of this parameter is your strategy. Are you a fundamental person? Are you a technical person? Are you an algorithmic or systematic person, right? So for myself and my clients, I trade and invest using algorithms. So my algorithm can make up to about 1 million decisions per second. And we typically day trade and or hold our approaches in scalping. So we technically can scan the market, identify a trading opportunity, enter the trade, and exit the trade in 8 milliseconds. So we typically trade between milliseconds up to about 4 hours is the average holding time if we are day trading for a particular strategy. That's completely different from investing. That's completely different from position trading. That's completely different. So each one of those have different strategies and different approaches. So you want to have a strategy that has been back tested and that that works, okay? Because that back test is going to help you have a high probability to predict the potential outcome. And so once you get that back test, you can say, hey, you know what? This opportunity meets my risk parameters. This opportunity doesn't. And so then you're going to only focus on that strategy or assets or instruments or opportunities that meet your risk parameters within that strategy. And you want to be able to have a strategy that is easy enough for you to understand and to execute and follow in a step-by-step manner, but complex enough where it's not easily repeatable and doable by everybody in the world, right? So you want a little balance of a little bit of complexity that you are able to find these opportunities, and you want simplicity that you're able to execute it in a routine step-by-step manner. All right. Now, after you've identified your strategy, okay, and your approach, now you can start getting to the cost of the trade. What is it going to actually cost you to get in the game? What is it going to cost you to play? You need to ask yourself these questions, okay? What are the margin requirements? Am I going to choose margin or I'm going to choose cash? Okay. Some brokerages charge margin or offer margin, and some don't. So you need to know that. And you need to know what that fee is. You want to make sure that the margin requirements are not above 5% of your available cash balance. Okay. So you want to know the margin requirements. You want to know if that brokerage charges margin, if you're going to be using cash or margin. The next cost question you want to ask yourself is, what are the transaction fees? Do they charge me to get into the trade? And do they charge me to get out of the trade? If I am looking at investing in a real estate property, what are the actual fees, right? What is the appraisal? What are the tax, title, lien, etc.? Whatever investment opportunity you're looking at, whatever trade you're looking at, you want to know the transaction cost to the very penny, because that's literally what you are paying up front to risk for that trade or investment opportunity. Okay. And then next, you want to know the actual cost of the asset and the instrument that you're considering. So if it's a stock, and let's say Apple is trading at $100, you need to know that Apple is trading at $100. Or you need to know that that real estate property is $100,000. Or you need to know that that cryptocurrency is $20. Whatever it is, you want to know the actual cost of one share, of one contract, of one instrument, of one house, of one multi-unit. You want to know the actual cost of that before you risk one penny. So all of these risk questions that we're going over right now, you need to ask yourself these questions, and you need to know the answer to these questions before you make the trade, before you make the investment, before you risk one penny. Okay? The next question I want you to ask yourself is, what is my stop loss and take profit? Where is the number, the exact number that I am willing to risk, the maximum amount I am willing to risk on this trade? And that number also must be within your 5% rule. So, for an example, if I have $1,000 in my account, and the margin requirement for this particular opportunity is $30, then $30 plus maybe the actual cost of the trade is $20. That will bring me to my $50. And that is the maximum that I would be willing to risk on this trade. It's $50 for every $1,000 that I have available. So if I do all of my parameters and I find a great opportunity, but it costs more than $50 for me to get in, and I only have $1,000, then that trade and that opportunity is not for me. And I will just continue to sit on the sidelines and I will wait. And that is where patience, self-control, and discipline come in, and sticking to your rules and sticking to your risk parameters. Okay. So you want to identify the cost of the actual asset or instrument that you are looking to trade in, invest in, or purchase. Okay. And then the stop loss and take profit is what it's saying, what is the maximum risk in that individual trade or investment? And then where are you going to be looking to capture your profits, take your gains off the table, right? And you want to know those numbers. So if I put in $1 and I'm projected to get $2 back, when am I projected to get that $2 back? How long will it take me to get that $2 back? At what areas will I maybe take profits off the table? Will I maybe take profits off at $1.20, at $1.50, at $1.80, or will I wait to get my whole $2 back? Right? So those are the things that you need to ask yourself when you're considering your stop loss and your take profit. Stop loss is what's the maximum I'm willing to risk in this, and take profit is what are the areas that I'm looking to protect my profits and capture my gains as I go through this trade or investment over time. Okay. And then the last question I want you to ask yourself is, how often will I be making this trade or investment? High frequency traders trade in nanoseconds. Position traders trade in weeks to months. Investors trade from years to decades, right? So you have to know the answer to these questions as you look at this opportunity that you are presented, and know that you're not going to win every trade. But if you put yourself in a high probability scenario by asking yourself these questions before you risk a penny, knowing the answers, and then controlling your energy and controlling your emotions while you manage the trade or investment, then you're going to be able to consistently put yourself in a high probability of success. Okay. So that pretty much summarizes today's episode of risk management, gives you some practical steps that you can follow in any trade, any investment, any asset class that you're considering. Whether you are a trader, whether you're an investor, whether you're in real estate, it doesn't matter. Whether you're investing in business, it doesn't matter the opportunity. If you can ask yourself those questions, keep it simple and stick to the plan, you have a shot at having success in business, finance, trading, and investing. Okay. So thanks again for joining me here on the Money Game podcast. I'm your host, Dion Pouncil. I really appreciate it. You could be anywhere in the world, but you decided to tune in here, and I am extremely grateful. Okay. So as always, love, light, peace, wealth, great health, and abundance to each of you guys. Have a great one, and I'll see you soon.